Welcome to CohnReznick's Accounting Standards Update webcast series focused on ASU number 2014-9, Revenue from Contracts with Customers. Today, in the first part of our four-part series of webcasts concerning the new revenue recognition standard, we are going to provide a high-level overview of the new standard, give you some transition considerations that should help you get started with your adoption efforts, and provide you with some next steps to help you along with your transition journey. It is a familiar scene in many thrillers, a hero or heroine working frantically to defuse a ticking time bomb. Well, there is an accounting time bomb of sorts currently winding down that is creating anxiety in many organizations that may not be doing enough to prepare for the major change that's on its way. That change is the FASB and IASB converged new standard on the recognition of revenue from contracts with customers, or ASU's update number 2014-9, Revenue from Contracts with Customers. The good news is that the date the standard goes into effect has been deferred, giving organizations an opportunity to take a pragmatic approach to implementing systems, gathering data, and resolving issues to ensure a smooth implementation. The FASB's new revenue recognition standard is intended to establish the principles necessary to report useful information to users of financial statements about the nature, timing, and uncertainty of revenue from contracts with customers. The ASU contains an overarching principle that a company should recognize revenue when it transfers goods or services to a customer. The amount of revenue recognition should be represented by the consideration to which the entity, i.e. the seller, expects to be entitled. The FASB's guidance affects any entity, public, private, or not-for-profit, that 1. Either enters into contracts with customers to transfer goods or services, or 2. Enters into contracts for the sale of non-financial assets unless those contracts are within the scope of other standards. The goal of the FASB and IASB converged guidance is to create a common revenue standard for U.S. GAAP and IFRS that removes inconsistencies and weaknesses in revenue requirements, provides a more robust framework for addressing revenue issues, improves comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets, provides more useful information to users of financial statements through improved requirements, and finally simplifies the preparation of financial statements by reducing the number of requirements. The only types of revenue-producing activities not affected by the new standard include leases, loans, investments, and guarantees, insurance contracts, and certain non-monetary exchanges. Other long-standing industry-specific guidelines will be eliminated on a going-forward basis. While the implementation of this standard has been delayed in the past, and the number of questions that have yet to be answered by either the FASB or the IASB remains large, organizations should work under the assumption that the dates being presented here will not be deferred again. For public organizations, the standard is scheduled to become effective for all annual reporting periods beginning after December 15, 2017. The ASU defines a public entity as any one of the following: a public business entity as described in ASU 2013-12, a not-for-profit entity that is issued or is a conduit bond obligor for securities that are traded, listed, or quoted on an exchange or an over-the-counter market, and an employee benefit plan that files or furnishes financial statements to the SEC. For non-public organizations, or effectively all other entities, the standard should be applied to annual reporting periods beginning after December 15, 2018. In the year of adoption, organizations can select from two methods of reporting. Under the full retrospective method, assuming a calendar year, U.S. GAAP public companies would adopt on January 1, 2018. In this case, all prior periods presented in the financial statements would be presented as though the new guidelines had always been in effect, with the optional use of one or more of the following practical expedients. 1. Entities would not need to restate completed contracts that began and ended with the same annual reporting period. 2. For completed contracts that have variable consideration, Entities may restate prior periods using the final transaction price rather than estimating the transaction price that would have been used throughout comparative reporting periods. Entities would not need to disclose the amount of transaction price allocated to remaining performance obligations and an explanation of when the entity expects to recognize that amount as revenue for periods presented before the date of initial application. Under the modified retrospective approach, entities would apply the new ASU only to contracts that are outstanding as of the date of adoption. This would involve comparing how those contracts would have been reported under the ASU with how they were actually booked under existing GAAP. Any necessary adjustments would be recorded in opening retained earnings on the date of adoption. Prior periods would not need to be restated. If companies elected this method of transition, they'll need to disclose the effect of adopting the new standard on each affected financial line item. As such, the footnotes would show pro forma balances had existing GAAP continue to be applied. Significant variances would require explanation. These disclosures would require entities to effectively keep two sets of books during the initial year of applying the new ASU. The modified retrospective transition method may require less dual record keeping, but it results in less comparability. Given revenue is a key performance indicator, many users will prefer the full retrospective transition method. Depending on the transition guidance you use, it will likely be more advantageous to actually run parallel systems in the year prior to implementation. Running parallel systems will give management a concurrent view of the changing revenue landscape of the organization. This may be far more beneficial to the organization than only looking backward to restate revenue amounts in the comparative periods that must be shown in the income statement. After 2018, the training wheels will come off and the new standard should be fully implemented. It should be noted that organizations should not put off the work needed to prepare for the changes involved with respect to the implementation of this new standard, since they will likely face challenges unlike those encountered during other accounting projects. In a recent survey conducted by PwC and the Financial Executives Research Foundation, or FERF, 78% of respondents said their company had not attempted to quantify the financial statement impact or impacts of the new standard. This is a strong indication that many companies are behind where they should be regarding implementation. Simply put, many companies do not yet have a complete understanding of how the standard will affect their organizations. Given that the impacts of the standard extend far beyond technical accounting, the level of preparedness, or lack thereof, just described may be a cause for concern, and rightly so. Most companies will see at least some leverage, while most public companies will not start applying the new guidance until 2018. Preparing for the change will likely require significant effort that could entail a substantial amount of time. So a roadmap to implementation. In addition to evaluating the potential impacts on financial statements, information systems, processes, and controls, companies should consider the following when planning to apply the new guidance. Understanding the changes to current GAAP based on FASB ASU 2014 revenue recognition from contracts with customers. Understand the transition and retrospective adoption of the revenue recognition standard and determine how the company will adopt the new guidance. Finding the resources to help train professional staff to ensure effective and efficient implementation of the revenue recognition standard, and educating users about the change they can expect to see in the company's financial statements. There is simply no silver bullet to address the new revenue recognition standard, and the time required for full implementation is going to vary from company to company. For the majority of organizations, the most challenging aspect of the transition will be identifying and deploying the right resources, including personnel, processes, and systems, to address the changes that are required under the new standard. Some other factors that may impact the complexity of the implementation and the corresponding time needed for a successful transition include the following: the number and diversity of contracts and revenue streams, the complexity of the contracts, the availability of and visibility into data required by the new standard, the company's current processes and systems, and finally resources, human and capital, external and internal. Clearly, organizations need to adequately plan for the potential changes to processes, systems, data, and internal controls across the business. Unfortunately, the only way to know how long it will take to implement the new standard is to start the process as soon as possible. CohnReznick is going to present the following transition timeline, which includes 8 steps. For both public and private entities, we recommend starting the transition activities as soon as possible. Below are the key transition steps and their associated timing. In Q3 2016, it is important to identify the project sponsors and change management group, as well as building an effective implementation task force. As you move forward into Q4 2016, it is important to make sure that you train and educate organizational personnel, understand the key revenue streams, accounting policies, and the respective treatments, and begin to select a sample of contracts and apply the standard. As we move forward into Q1 2017, it's important to conduct an impact assessment, and as the remainder of 2017 is underway, it is important to begin the commencing of the conversion process, because by 2018, it is important to have fully implemented and embedded new processes to comply with the new standard on a going forward basis. So getting started. If management has not already assembled the team that will sponsor and take ownership of the transition process, doing so now is highly recommended. Postponing this any longer could have detrimental effects on an effective implementation plan. Sponsorship of the implementation process should include the CFO and CAO at a minimum. This group will be primarily responsible for approving the overall funding requirements of the project, managing the timetable, and monitoring the project's overall status. They will also be responsible for the overall transition strategy and may be the individuals responsible for communicating with the audit committee, at least in the case of public companies. Identifying the project sponsors and change management group. Broader change management should consist of a steering committee and a project management office or officer that is responsible for the following: supporting the audit committee where applicable, supporting external auditors, communicating with various internal leaders and stakeholders who will be impacted, determining staffing, resources, and other trade-offs, and managing the organization's resources and timelines. It's extremely important for the governance structure of the organization to include members from various functions within the organization, including accounting and finance, information technology or IT, the sales and operations teams, and others. It is extremely important to have members of the sales and operations team involved early in the process, as they are critical in identifying important aspects of any contracts with the entity's customers. Furthermore, the sales team will be able to provide the team with much needed information about the company's processes for negotiating with its customers. In particular, the sales or operations team members will quickly identify whether the organization has a few standard contracts or if there are many individual contracts that are based upon specific negotiations with each customer. Of course, the accounting and finance team will need to understand how each type of contract will be treated under the new standard and identify issues that may lead to possible changes in processes, internal controls, information systems, or even future contracts. Given the likelihood that there may be significant impacts on the company's business systems, IT stakeholders will need to work closely with the accounting and finance teams, sales and operations, and others to determine technology-enabled future state processes and capabilities necessary to implement the new standard. Early awareness, thoughtful planning, and regular interaction among IT and key stakeholders is critical in both short-term and long-term IT strategic planning should be considered when assessing the overall impact on other IT projects to ensure that new system requirements are also aligned with the future state of revenue recognition within the company. Finally, and perhaps equally as important as the other groups previously mentioned, depending on the nature and type of contracts with customers the entity may be party to, the inclusion of some of the other functional organizations within the company should also be part of the implementation task force. These groups would include human resources, when commission structure plays an important part in contracts with customers, or when considering employee compensation agreements, the legal department, when considering the modification of current contract terms or when drafting new customer contracts. And finally, the tax department, when it is likely that there may be significant changes in regards to the timing of revenue recognition. Next steps. The new revenue recognition standard is a game changer, and preparing for it can be daunting, but time is currently on your side. Getting started now is the key to being ready for this historic change. Over the course of the next few months, we will offer practical guidance on how to implement the steps on the transition timeline previously presented. In our next installment, we will focus on the Q4 2016 activities, namely training and educating organizational personnel, and understanding how the key revenue streams, accounting policies, and accounting treatments will affect the organization. Thank you for your time and participation today, and I will look forward to catching up with you in our next webcast series.